Every few decades, the banking system does something extraordinary. It breaks, not slowly, not politely, but violently. Credit disappears, markets freeze, governments panic, and institutions that once looked untouchable collapse in days. Today, we're counting down the 5 biggest banking crises in history, the moments when the global financial system came closest to the edge. These aren't just economic stories, they're power stories, confidence stories, and warnings. Let's begin. The first crisis takes us back almost a century to a time when banks failed, not because of complex derivatives, but because people simply stopped believing. Number 5, the Great Depression banking collapse, 1929 to 1933. When the US stock market crashed in 1929, it didn't just wipe out investors, it shattered trust. Banks at the time were thinly capitalized, lightly regulated, and deeply exposed to the stock market. When asset prices collapsed, depositors panicked. And when depositors panic, banks die. Between 1930 and 1933, more than 9,000 US banks failed. Entire communities lost their savings. Businesses couldn't access credit. The economy suffocated. This wasn't a financial crisis. It was a banking extinction event. The damage was so severe that it forced the creation of the FDIC, deposit insurance, and the modern regulatory state. The lesson was brutal and simple. When confidence goes, the system goes with it. And it set the template for every crisis that followed. The second crisis moves us forward half a century to the moment when inflation, bad loans, and political pressure collided. Number 4, the US savings and loan crisis, 1980s. Savings and loans were supposed to be boring. They took deposits and made mortgages. That was it. But in the late 1970s, inflation exploded. Interest rates surged, and suddenly S&M Ls were paying more on deposits than they were earning on long-term fixed-rate mortgages. They were insolvent in slow motion. Instead of shutting them down, regulators deregulated them, allowing S&M Ls to take more risk to earn their way out. It backfired. Bad loans, fraud, speculation, and outright criminal behavior exploded across the sector. By the time the crisis ended, over 1,000 institutions had failed, the cost exceeded $150 billion, and the US government was forced into mass bailouts. The lesson? When regulators loosen standards to avoid pain, they often multiply it. The third crisis takes us to Asia and to a moment when foreign capital, currency pegs, and fragile banks collided. Number 3, the Asian financial crisis, 97. In the 1990s, Asia was booming. Capital was flooding in. Growth was strong. Currencies were pegged to the dollar. Banks borrowed in dollars. They lent in local currencies. They assumed stability. Then the pegs broke. Currencies collapsed. Debt exploded. And banking systems across Thailand, Indonesia, South Korea, and beyond imploded. Entire financial sectors were wiped out. Governments had to nationalize banks. IMF bailouts followed. Millions were thrown into poverty. This crisis taught markets something uncomfortable. Global capital is fast, but it is not loyal. When it leaves, it doesn't walk, it runs. And banks are always the ones left holding the damage. The fourth crisis is the one most people remember, but few truly understand. Number 2, the global financial crisis, 2008. This was not a housing crisis. It was not a subprime crisis. It was a banking crisis. Banks had built enormous leverage on top of mortgage debt. They packaged it, securitized it, insured it, and sold it across the world. The same risk multiplied. When US house prices fell, the entire structure cracked. Lehman Brothers collapsed. Bear Stearns vanished. Washington Mutual failed. IG was nationalized. RBS, UBS, Citigroup, and dozens more were saved by the state. Interbank lending froze, credit markets died, and governments were forced to inject trillions to stop the system from collapsing. This was the closest modern finance has come to total failure. ATMs were days from shutting. Payroll systems were at risk. Global trade seized. It wasn't just banks that were in danger. It was society. The lesson from 2008 is still not fully absorbed. Banks are not independent entities. They are the plumbing of the economy. When they fail, everything fails. And that brings us to number one, the crisis that is still unfolding, the one that hasn't fully ended, the one that may define this era. Number one, the European sovereign and banking crisis, 2010 to present. After 2008, Europe tried to pretend it was different. It wasn't. Banks across Greece, Spain, Italy, Portugal, and Ireland were stuffed with government bonds and property loans. When growth stalled and debts ballooned, the link between banks and states became lethal. If governments failed, banks failed. If banks failed, governments failed. It was a doom loop. Greece nearly left the euro. Spanish banks were rescued. Irish banks were nationalized. Italian banks were restructured. And in 2023, Credit Suisse collapsed, a 167-year-old institution wiped out in a weekend. This crisis never truly ended. It just went quiet. And that's what makes it dangerous, because slow crises create complacency, and complacency breeds risk. Today, banks are larger, more interconnected, more complex. Derivatives markets are bigger. Funding is more fragile. Confidence is thinner. And the system still rests on the same foundation it always has: trust. Every crisis on this list has one common thread: not greed, not stupidity, not even fraud, but confidence. When confidence goes, capital goes. When capital goes, liquidity goes. And when liquidity goes, banks die. That is the hidden truth of finance. Banks don't fail because they're evil. They fail because they are fragile, highly leveraged, highly interconnected, and utterly dependent on belief. That's why crises are never small. That's why they are never local. And that's why they are never clean. Because when the banking system breaks, it doesn't just hurt investors. It reshapes economies, it changes politics, and it leaves scars that last decades. The next crisis will not look like the last one. It never does, but it will follow the same pattern: leverage, complacency, shock, panic, and then damage. If you want more deep dives into the hidden mechanics of markets, the real stories behind financial power, and the decisions that shape the global economy, hit subscribe. And if there's a crisis, collapse, or financial story you want broken down next, drop it in the comments, because in finance, the most important stories are always the ones that happen when everyone thinks everything is fine.